Welcome to the weekly wrap-up, folks. Apologize, had to go close the door. It was a little loud, so still having a bunch of construction done here at the house, having a new water system and furnace and all that good stuff put in. So hopefully it's all done by the end of the day. Would be nice to have hot water to wash my hands. And cold water coming out of this mountain ground is quite chilly. So, like I said, the kind of kerfuffled today. So anyways, hope everyone's had a great week. We're headed into the weekend. So hopefully everyone's has got some fun plans. For me, I'm going to watch a lot of baseball. That's just what I like to do. Probably play with the dogs outside, throw the ball up and down the hill, watch my pup chase after it. And the older dog just sit around and watch him run back and forth. So anyways, if it's your first time watching, please give me a thumbs up, a like, a share, whatever, all that good stuff. That's how I spread the message of financial literacy and what's going on in the world. So, all right, well, let's go ahead and take a peek and see how the indexes did today. The Dow Jones just closed down 2.82%, 981 points down. It dropped at least 100 points probably in the last 15 minutes. So it looks like there were a lot of sellers at the end of the session. The S&P 500 was down 2.72, closing up. I'm sorry, let me start over. The Dow closed at 33,811. The S&P 500 closed at 4274. The NASDAQ closed down 2.55% at 12,839. The small caps were also down 2.5%. The VIX was up 24.56% today. So that's a little more, about 5.5 points to put us at around 28.24 right now. The other exchanges here in the Americas, Canada was down 2.14, Brazil down 3.14, Mexico was down 0.14. Moving over to Western Europe, Germany was down 2.5%, the UK down 1.39%. France was down just under 2 at 1.99. The Euro stocks was down 2.25. Netherlands down 1.62. Spain was down 1.84. Italy down 2.12. And again, lots of 1%, 2%. The two Russian indexes were down. The MOEX was down 1.71. The RTSI was down 3.45. Turkey was also in the red, down 3.30. Israel slightly up at 0.20 up. Let's see here. Getting over into the Asian markets, the Nike was down 1.63. Australia was down 1.57. New Zealand down 0.56. A little bit of green here in the Chinese markets. The Shanghai was up 0.23. The SE component was down 0.29. The China A50 up 0.83, the DJ Shanghai up 0.2, and the Hang Seng down 0.21, and the Taiwan weighted down 0.6. So not a real good day. Looks like a lot of selling going on. I don't know if people are getting the clue that the markets are a mess right now. So maybe we're just seeing people exit those positions and move on to something else. So all right, well, let's take a look and see how the indexes did for the week. All righty. See, we started there on the 18th. We're going to finish down for the week in the Dow Jones down 1.65. The S&P 500 going to be down about 2.5%. NASDAQ for the week down about 3.61. Dow Utilities going to finish down 1.91. And the Dow Transports looks like they're going to finish in the green about 1.76. So for most of the week, things were looking pretty good. We started out here on Monday. We had a nice, let's see what our gain was midweek at its highest point. We were up about 3% for the week and gave it all back up in the last 2 days. So again, looking at what's going on in the world, it's not surprising that we're seeing this volatility all of a sudden. So, all right, so let's close that out and move over to what's going on as far as economic data that came out this week. All Right. U.S. housing starts, they came in at 1.793 million. The forecast was 1.745 million. So about the same, a little bit more than last month. But again, looking here at this chart, the trend still seems pretty strong. So, I would imagine with interest rates creeping up that, new starts will probably drop off sooner than later. Existing home sales came in at 5.77 million. Forecast was 5.8, so just a hair under forecast. We can see the last 2 months we've had a slide from our February numbers where we were at about 6.5 million. So, but again, it's not as bad as it was 2 years ago. In June, we were down at around under 4 million. So, again, and there's been a lot of people moving around. A lot of people realize, hey, I don't want to live in the city anymore. I don't want to deal with lots of regulations and laws that you don't agree with. So a lot of people like me, I mean, I did this well before all this came down the pipe, but I moved out to the middle of nowhere 5 years ago, and probably one of the smartest decisions we ever made. So, all right, United States leading index month over month. Let's see. We came in at a 0.3. The forecast was 0.3. Last month was 0.6. So dropped by about 50% from last month's number. But again, it's still in the plus. So that is certainly a good thing. U.S. Markit Composite Purchasers Managers Index came in at a 55.1. The forecast was 57. So quite a big miss there for this month. So, well, maybe not huge. So about 2 points. So we did have a step back from last month's number where we were at 57.7. They were expecting, a slight pullback, but it pulled back a little more than what the analysts were expecting. So, all right. Well, that's all the economic data, I think. So let's see. I got 1, 2, 3, 4 articles and some audio to listen to over the next few minutes. So let's go ahead and blaze through what's going on in the world. So this first one is just a recap of today's market. S&P and Bloodbath as softer earnings, rate hike, jitters bite. The S&P 500 fell sharply Friday, weighed down mostly by disappointing quarterly earnings from corporates and rising bets on even more aggressive Federal Reserve monetary policy tightening ahead. Again, if you are completely caught off guard about raising interest rates and quantitative tightening, you haven't been paying attention and you definitely haven't been watching this show. All right. Healthcare was one of the worst performing sectors on the day, pressuring the broader market, paced by a slump in HCA and Intuitive Surgical. HCA Holdings fell more than 20% after reporting mixed quarterly results and cutting its full year guidance following the impact of the pandemic and rising costs. Intuitive Surgical fell more than 14% as its better than expected first quarter results were overshadowed by lack of the following through. Hang on, somebody's coming in. Sorry about that. Had one of my contractors come by here, so I apologize. Let's see. HEA Holding, here we were. Better than expected quarter results were overshadowed by the lack of follow through on the procedure guide and the commentary and a potential softer U.S. capital pipeline. End quote. Raymond James said in its price target on the stock from 330 or to 330 from 334. Sentiment on stock was also soured by expectations that the Federal Reserve is set for an even tighter path of monetary policy following hawkish remarks from Chairman Jerome Powell a day earlier. Powell on Wednesday said that a 50 basis point hike was on the table for a May meeting and added that the central bank was open to front-loading more than 50 basis point hike beyond the May meeting. Duh. Quote, the market was already anticipating 50 basis point hike next month. Going forward, however, against the backdrop of this week's Fed commentary, an even larger 75 basis point hike is now on the table, Stifel said in a note. The 10-year Treasury yield briefly rose to its highest since 2018 before giving up gains, while the 2-year Treasury yield, which is more sensitive to Fed rate hikes, continued to advance. Against the backdrop of rising rates, the enemy of growth stocks, tech, continued to trade in the red. Google, parent Alphabet, Amazon, Microsoft, Apple, and Meta were down more than 1%. Communication services were also a big drag on the broader market after Verizon Communications suffered its biggest drop in more than 2 years. The telecom giant cut its full year sales forecast. So again, I think a lot of the things that I've been preparing for over the last 6 to 9 months are starting to come to fruition. So beard's a mess today. So, all right. Next article here. Oil falls on growth concerns, Shanghai lockdown. Oil slipped on Friday and headed for a weekly decline, burdened by the prospect of weaker global growth, interest rate hikes or higher interest rates, and COVID lockdowns in China hurting demand, even as the European Union considers a ban on Russian oil that would further tighten supply. Brent crude was down $2 or $1 or 1.85% at $106.32 a barrel. West Texas International crude declined $2.01 or 1.94% to 101.8. The International Monetary Fund, which cut its global economic growth forecast, could further downgrade if Western countries expand their sanctions against Russia over its war against Ukraine and energy prices rise further. The IMF's number 2 official said the German government will cut its growth forecast for 2022 to 2.2% from 3.6%, a government source said, while Chinese demand for gasoline, diesel, and aviation fuel in April is expected to slide 20% from a year earlier. Bloomberg reported as many of China's biggest cities, including Shanghai, are in COVID-19 lockdowns. Yeah, because you might catch a cold. U.S. Federal Reserve Chair Jerome Powell on Thursday said a half-point increase to interest rates will be on the table, in quotes, at the next Fed policy meeting in May, pushing the dollar to a more than 2-year high. Stronger greenbacks makes oil and other commodities more expensive for those holding other currencies. Quote, at this stage, fears over China's growth and over-tightening by the Fed capping U.S. growth seem to be balancing out concerns that Europe will soon widen sanctions on Russia energy imports, end quote, said Jeffrey Halley, analyst at brokerage Owanda. Brent hit $139 a barrel last month, its highest since 2008, but both oil benchmarks were headed for weekly declines of nearly 5%. On the supply side, the Russian-Kazakh Caspian Pipeline Consortium is expected to resume full exports from April 22nd after almost 30 days of disruption, sources said. U.S. oil rigs rose to 549 this week, their highest since April of 2020, according to a report from energy services firm Baker Hughes. Still, ongoing support was provided by supply tightness after disruptions in Libya, which is losing 550,000 barrels per day out of output, and supply could be squeezed further if European Union imposes an embargo on Russian oil. Morgan Stanley raised its third quarter price forecast for Brent by $10 per barrel to $130, citing a greater deficit this year due to lower supply from Russia and Iran, which is likely to outweigh short-term demand headwinds. Quote, so we may slide. There's a certain point at which we may find support because the fundamentals here. The stakes are just too tight for things to slide very far, Mizuno Executive Director of Energy Futures Robert Yager said. An EU source told Reuters this week that the European Commission is working to speed up availability of alternative energy supplies, while a senior White House advisor said he's confident Europe is determined to close off or further restrict remaining Russian oil and gas imports. The Netherlands said it plans to stop using Russian fossil fuels by the end of the year. European refiners processed 9.04 million barrels per day of crude oil in March, down 4% from a month earlier and 4.8% higher than a year earlier. Euroslick data showed. U.S. oil refineries, on the other hand, are expected to have about 1.08 million barrels per day of capacity offline for the week ending April 22nd, increasing availability refining capacity by 47,000 barrels per day, research company IRR Energy said. So it looks like oil is slipping a little bit, but based on the analysts' projections, they're pegging it at about $130 a barrel right now. So we'll see where things go. Again, the number of rigs online, we were in the high 700s, 2+ years ago, and now we're mid 500s. It has increased a lot over the last year, but we're still way behind the 8 ball there. All right. Next article I got here, what home prices will look like in 2023, according to Zillow's revised downward forecast. There's no doubt about it. Soaring mortgage rates are an economic shock to the U.S. housing market. Over the past month alone, the average 30-year fixed mortgage rate has spiked from 3.11% to 5.11%. It's both pricing out some stretched home buyers and causing some would-be home borrowers to lose their mortgage eligibility. The swift move up in mortgage rates has research firms re-gearing their housing forecast models. Heading into 2022, real estate research firms presumed the Federal Reserve would put upward pressure on rates, but not like this. Let me stop you there. Did you not think interest rates were going to have to, inflation was already late last year, probably north of 5 or 6%. Did you not think that interest rates were going to have to at least go that high to, squash the inflation and help it, recede and slow down the economy? I mean, come on, people. You're in the housing business. You should know this stuff. Where were we? On the year, the Mortgage Bankers Association forecasted the average 30-year fixed rate would climb to 4%, while Fannie Mae forecasted a 3.3% mortgage rate by year's end. Well, we're way past that. We blew past those estimates weeks ago. Now, real estate researchers are dialing down their home price forecasts. On Wednesday, Zillow researchers released a revised forecast predicting that U.S. home prices would rise 14.9% between March 2022 and March of 23. That's down 2.9% from points from last month, when Zillow said home prices would shoot up 17.8% over the coming year. Quote, driving the downward revised forecasts are affordability headwinds that have strengthened faster than expected, largely due to sharp increases in mortgage rates, end quote, wrote the Zillow researchers. Quote, further risks to the outlook as well. Inventory remains near record lows, but have the potential to recover faster than anticipated, which could lower future prices and sales volume projections. So you can see here on this little chart, you can see where home growth has gone up and up and up. And, you can see this retracement back down from where we're at right now. The fact that Zillow has cut its forecast shouldn't come as a surprise. After all, the swift move up in rates is creating a serious affordability crunch for home buyers. At a 3.11 fixed mortgage rate in December, a borrower could owe a principal and interest payment of $21.38 on a $500,000 mortgage. That payment would spike to $27.18 if taken out at 5.11% rate. Over the course of a 30-year loan, that's an additional $208,800. If Zillow is right and home prices do rise another 14.9% over the coming 12 months, it'd mark another historically strong year for home price growth over the past 12 months. Home prices are up a staggering 19.2%. Each of those figures are outliers compared to the average annual U.S. home price growth of 4.6% posted since 1987. Even with, quote, even with the downward revision from last month, these figures would represent a remarkably competitive housing market in the coming year, writes the Zillow researchers. But not everyone is as bullish as Zillow. Over the coming year, CoreLogic predicts that home prices are set to decelerate to a 5% rate of growth. Mortgage Bankers Association says home prices are poised to rise 4.8% over the coming 12 months, while Fannie Mae predicts home prices will rise 11.2% this year, and 4.2% in 2023. Of course, there's a chance they're all wrong. The Federal Reserve Bank of Dallas has also found signs that the U.S. home price growth is greater than underlying economic fundamentals would push it up. The title of the Dallas Fed paper is blunt, quote, real-time market monitoring finds signs of brewing U.S. housing bubble, end quote. Our evidence points to an abnormal U.S. housing market behavior for the first time since the boom in the early 2000s. Reasons for concern are clear in certain economic indicators. Prices appear increasingly out of step with fundamentals, wrote the Dallas Fed researchers. While CoreLogic says housing market correction is unlikely over the coming year, the research firm does say that most housing markets across the country are overpriced. The firm calculated a market risk assessment for nearly 400 metropolitan statistical areas. The finding, CoreLogic deems 65% of the U.S. regional housing market to be overvalued. Both home buyers and home sellers alike might want to take housing forecasts with a grain of salt. Look no further than the housing forecast published during the COVID-19 recession. In the spring of 2020, both Zillow and CoreLogic published economic models predicting that U.S. home prices would fall by spring of 2021. That price drop never came. Instead, the housing market went on a historic run that continues as of today. So, I do see a scenario where home prices could actually start receding, and that is if we do go into some sort of a long, drawn-out recession, depression. It's certainly on the table. Odds are lower than just a bear market or just your typical recession. But if the economy slows down to the point where you have a lot of people out of work, then foreclosures will increase, There'll be people who will be displaced, and then then you'll have more inventory on the market, which will then push down, put some downward pressure on prices. So we'll see. It's kind of a wait and see what happens. Once the music stops and the free money from the Fed and the Treasury runs out, I have no idea what's going to happen. I have some scenarios in my head. It could be awful. Could lead to the downfall of the U.S. government, which I'm not going to be sad about that. If we get rid of those parasites, I'd be quite happy. But the carnage that'll come with it, I don't know I don't think a lot of people are prepared for what's up next. So, all right, one more article I got going here. This type of senior is struggling to afford retirement. Amid an economic environment marked by inflation, single seniors are having a harder time in retirement compared to married seniors, a new survey has found. Results of the American Advisors Group survey suggested unmarried seniors have less money than they thought they would have in retirement, expressed a desire to increase their monthly cash flow, and have a higher reliance on Social Security as their primary source of income. AAG's model retirement survey polled more than 1,500 senior homeowners between 60 and 75 years old to gauge how they feel about their finances in the current economic climate. The survey was conducted in December of 2021 as inflation reached 7%. The price of goods and services have continued to increase since then, rising 8.5% in the 12-month period through the end of March. Unmarried seniors appear less comfortable with their current financial situations when compared to married seniors. While 46% of single seniors said they would like to increase their monthly cash flow, only 32% of married seniors reported the same feeling. A higher percentage of single seniors, 44%, also said they have less money in retirement savings than they thought they would have, compared to just 32% of married seniors. Retirement planning is another area where unmarried seniors seem to have struggled more acutely than married couples. 36% of single seniors said their retirement did not work out as planned. Only 23% of married seniors responded the same way. When it comes to income sources, unmarried seniors are more reliant on Social Security than married couples. Social Security benefits were the primary source of income for 39% of single seniors, while pension funds were the most popular answer among married seniors, 31%. The disparity between single and married seniors is even more pronounced when examining the responses of single women. Half of all single senior women reported a desire to increase their monthly cash flow amid the current economic environment, while 45% said they ended up with less in retirement savings than they expected. To better prepare for the uncertainty and challenges that potentially lie ahead, seniors can take a number of steps to improve their financial outlook in retirement. If you haven't already begun claiming Social Security, you may want to consider delaying it. Good idea. Wait till 70. This may require you to work an extra year or two and perhaps employ a Social Security bridge strategy, locking in higher monthly benefits that may help you in the long run. However, it's also important to keep in mind that you'll need to live long enough to make delaying Social Security worth it. It will take several years to eventually come out ahead compared to claiming earlier. A reverse mortgage is another way to generate more income in retirement. This type of home loan allows people age 62 and older to convert their home equity into cash flow by borrowing against the value of their loan or of their home. The resulting cash or line of credit does not need to be repaid on a monthly basis, but the loan balance is due when the borrower moves or dies. As a result, a reverse mortgage can lessen the value of a retiree's estate and reduce the amount of money beneficiaries may inherit one day. Well, it's better than starving to death. I mean, when I was a debt collector, I used to talk to people who ate cat food because it was so much more affordable than regular food. And it was very sad. I mean, you're talking with someone, they're in bad financial straits, and they're talking about eating Alpo. I mean, it's just awful. However, research published in the Journal of Financial Planning found that reverse mortgages can help retirees protect their portfolios from market dips and extend their savings. Instead of relying on distributions from investments, a retiree can temporarily replace those withdrawals with income from a reverse mortgage line of credit when their portfolio loses value during downturns. According to the study, this strategy can reduce sequence of return risk and preserve a retiree's portfolio for longer. Bottom line, single seniors have a hard time coping with elevated inflation and the current economic challenges compared to married seniors. A survey of more than 1,500 seniors found the study concluded that single seniors, they just had the same text. It's like they summarized it and said the exact same thing. So anyways, all right. Last thing I got here is an article, or I'm sorry, some audio comes from Whitney Webb. Her podcast is Unlimited Hangout. Her guest is John Titus, and they're talking about, all the financial stuff going on in the world, the big things. and what John sees coming down the pipeline. So let's go ahead and let me just drag this over here. Yeah, let me put it over here. All right, so we're starting at about 26 minutes in. So we're going to list for a couple of minutes at 1.25 speed. So I would recommend listening to this at your own leisure. So let's go ahead and dive into this.
That I've come across in that context too, like the role of one of Leslie Wexner's top cronies in selecting Jamie Dimon as head of JP Morgan. Yep. JP Morgan becomes Epstein's bank after Bear Stearns collapse,
which was the biggest beneficiary of that bailout. JP Morgan mopped up to the tune of about $55 billion from the failure of Bear Stearns.
Yeah, so it definitely seems to have been one of several financial coup d'etats of the past several decades, benefiting essentially the same network of people.
You got it.
It's a really crazy story, and I don't know. Now it seems like we're in their end game,
yes.
Financially. So there's a lot of history to that. I guess we could discuss it at length, but returning to the topics at hand, unless there's anything else you want to say on those matters,
just on the end game. Because I think you're exactly right about the end game, but I'm going to explain what I agree we're in the end game, but I want to explain what I mean by the end game. I've got that, like I say, my most recent video, your Federal Reserve cancer prescription is ready for pickup, talks about this. The end game to me means the U.S. is now the end game to me means the U.S. is now borrowing to make its interest payment. Okay, and by interest, I don't mean just the interest on the debt, although that's included. The interest payment really it's what you owe as a result of a contract, be it a contract on a bond or a social contract like Social Security, Medicare, Medicaid, and whatnot. You can't really cut those payments because the deal when you go into the labor force is, hey, when you're younger and healthier, you pay into the system. And when you're older and weaker and you're not making as much money, you get your money back out of the system.
Mm-hmm.
When you add up interest plus Medicare plus Medicaid plus Social Security, it is now in excess of tax receipts, and you are thus borrowing to make your interest payments, meaning you're done. You now are looking at an exponential growth of debt way beyond your means, and it's over. And that's where the U.S. is right now. And that is why Powell and BlackRock and Yellen are all joining together saying, yeah, the fiscal path is unsustainable. They cite other reasons than what I just gave you, but that's the reason, rest assured.
Sure. Yeah. I mean, I think it's pretty safe to say that the vast majority of Americans would not take kindly to the Social Security system having been known to be insolvent for some time and not being informed about it until it's just like not there anymore.
Yeah.
And then, the role of BlackRock and stuff, which we talked about the last time you were on, they also, if I'm not mistaken, control a lot of America's pension funds as well, which is
well, they have $10 trillion in assets. Yeah. Yeah.
Yeah, recipe for total disaster. That's for sure. So anyway, going back to some of the stuff that's happened on the global level, we have this whole other development that we haven't quite discussed yet. Well, I think you alluded to it earlier about Russia asking unfriendly nations to pay for energy expenses, hydrocarbon purchases in the ruble. What's your take on that?
Yeah.
Do you think it'll work?
Well, Russia's got the gas, so yes, it's going to work.
Right.
Want the gas? I mean, what's your other option? If you don't want to pay for the gas, what are you going to beat it out of Russia? How's that working out for you in Ukraine? Not so well, is it?
Right.
Yeah.
Well, one of the things I've sort of considered here is that it might be a way for Europe to advance the Great Reset agenda, the sort of the WEF. The agenda as described by the WEF towards sort of green energy, quote unquote, which involves really squeezing out, even before all of this unfolded in Ukraine, sort of squeezing the standard of living of the people there as it relates to energy availability. I don't know if you have any opinions on that.
Well, back to the Gazprom bank. What Russia did was they said, hey, look, it's not that you have to pay it in rubles. It's you have to pay it to a bank that's beyond your sanctions, which means a bank in Russia, which has the Gazprom bank. So we don't care. You can pay it in dollars. You can pay your gas bill in euros, whatever you want to pay. It's your choice. You can pay it in rubles. That's fine too, but you're going to pay it at our bank. And we'll take care of the rest, but you're paying it at our bank. You're paying it at a non-sanctioned bank because the West can't sanction a bank that's out of its jurisdiction, right? It can only sanction banks that are in its circuit. So it's free to sanction banks in the US and Europe or wherever. You can't sanction a bank inside of Russia. And that's really the essence of that story. It's not that simple. It's not that complicated. I think people have overcomplicated that whole thing. I mean, they just, Putin sidestepped these guys like they were, kindergartners. And said, pay in our bank. And that's what's going on. And like you're saying, though, the victim of all this, the people who are absorbing the brunt of what's going on it's really Europe that's going to pay the price here, both in terms of higher energy prices or no heat. Take your
right. Well, that's already, abundantly clear, especially in places like the UK where energy costs have already, the media there's already admitting that standard of living has been hit pretty hard there because of the extreme and rapid rise in energy costs, but a lot of people, I guess, through the war propaganda have been sort of trained to, oh, it's we'll sacrifice anything as long as we're helping Ukrainians. But I mean, it's hard to argue that the sanctions are actually like helping Ukrainians, especially with like Russia being able to easily circumvent all of this. And there's other arguments they made about how it's not necessarily helping Ukrainians either, but it's sort of manipulating sort of this empathy for people abroad as their standard of living is demolished. And I don't know. Do you see this as incompetence on the part of UK leaders? The fact that they're even calling for more sanctions in the West that didn't work and probably won't work again, or will be circumvented again. Is it incompetence, or is there an ulterior motive here?
I think it's part incompetence. It's part narcissistic personality disorder of some of the characters involved, and certainly some of it is deliberate. But you mentioned WEF, World Economic Forum. And I'll just tell you right now, my read of that group might be a little bit different than a lot of other people.
Sure, that's good.
In the alternative media space. Because I'm curious about them too. Like, what is this group? Why are they getting so much attention? What's up with them? And so I spent some time sort of thumbing through their website. And the first thing I noticed about the WEF, you mentioned you worked on Epstein's book, right? You did a whole book on Epstein. One of the things I noticed with Epstein, when I like going through photographs because the camera doesn't lie, right? And I go through these photographs of these people involved with Epstein, and I'm like, these are all chumps. You never see like a major real power player with Epstein. It's always these chumps like Bill Gates.
All right, that's about everything there. So, like I said, it's a good listen. It's about an hour and 40 minutes. So I would, if you have some time, I always recommend turning the speed on these things up to about 1. I listen at 1.5 speed just because I like to jam through as much material as quickly as I can. But it is, like I said, it is definitely a good listen. So I would make some time to try to digest all of that material. So, all right. Well, that's everything I had for today. I hope everyone has a fantastic weekend. If anyone needs anything from me, don't hesitate to reach out. You can go to dsafinancialgroup.com. All my contact information is there. I hope everyone has a fantastic weekend, and I will be back on Monday with the weekly economic update. So hope to entertain you guys then, and have a great weekend. Bye-bye.